The master budget is going to be an integrated set of operating and financing budgets for a period of time. So we're going to break down the different budgets that we need, and we're going to call them either an operating budget or a financial budget. So the operating budget can be used to prepare a budgeted income statement. The financial budget can provide information for a budgeted balance sheet. Most companies prepare a master budget on a yearly basis. Here's an example of what makes up a master budget from a manufacturing company. So the first thing we need to know is, what do we expect our sales to be? Then based on that, what our cost of goods sold will be, which is production budget, direct materials, direct labor, factory overhead, and selling and administrative expenses. So we have to go in that order because each of those pieces feeds into the next budget. And then our financial budgets are going to be the cash budget and the capital expenditures budget. So the cash budget is what you expect the cash inflows and outflows to be. And then the capital expenditures budget is what you expect to have to purchase as far as long-term assets. All right, let's look again at the operating budget. So first we need to know how much we expect to sell. So that we know how much we need to produce, and then how much we'll need to produce is going to tell us how much direct materials, direct labor, factory overhead we need. And then that's going to be the total amount we expect for cost of goods sold. And then we also have our selling and administrative expenses budget, which happens outside of our factory. And then all that goes into our budgeted income statement. So we need all that information to make our budgeted income statement. Remember, a budgeted income statement is going to have your sales minus your cost of goods sold. Remember, that's all of these items. And then minus selling and administrative expenses to get to our net income. So the sales budget begins by estimating the quantity of sales. How many units do we think will sell? The prior year's sales are often used as a starting point. How much did we sell last year? Do we think we're going to sell the same or more or less? Based on different factors, are we doing more advertising, more promotions? Are we going to raise prices, lower prices? And what will we do to the quantity we sell? And what is the expected industry and general economic conditions? So right now, over the past few years, we've noticed the COVID which has changed a lot of things. So it would change our budget. We would have to reflect those changes. So in some industries, COVID-19 may increase sales. So healthcare, masks, ventilators, your sales would be increasing. If you're in tourism or some other area, then it could be decreasing. So that's what we mean by expected industry and general economic conditions. Even if we didn't have the global pandemic, we still have other things that we would need to take into account. So companies and businesses, the budget will look different each year. And once sales quantities are estimated, the budgeted sales revenue can be determined as follows. Take the budgeted revenue, calculate it by taking the expected sales volume times what we expect to sell it for, which is the expected unit sales price. So Elite Accessories manufactures wallets and handbags that are sold in two regions, the East and West regions. Elite Accessories estimates the following sales volumes and prices. And in the East region, we're going to have this sales volume. The West, we're going to have this. And the unit selling price, no matter where we are, is $12 for the wallets and $25 for handbags. So when we make that sales budget, it's going to look like this. The unit sales volume for the East times the price, and then the West times the price for the total. That's for your wallets. And then we'll do the same thing for the handbags. What you'll see a lot is quantity times price in these budgets, and that gets us to our total revenue from sales. So for the production budget, we're going to be looking at the total number of units that we need to manufacture to meet the sales. And we also want to build in the desired amount of inventory, because most companies want to have some inventory going into the next month or into the next period. So we're going to be told how much that desired ending inventory is. So we expect to sell these number of units. We want to have a desired ending inventory. Then we can subtract out the beginning inventory, because we already have those and we don't need to produce them. And that's going to tell us how many units we need to produce. Okay, so this is what Elite expects the following inventories of wallets and handbags to be. You can see we have an estimated inventory of 88,000 at the beginning, and we have desired ending inventory of 80,000 for the wallets. And then we're given the same information of what we expect and desire for the handbags. So when we put it into a production budget, it looks like this. We expect the units to be sold, this number of units. We want this number of ending inventory, so we add. That tells us the total units required. But we don't need to make the ones that we started with, because we already have them in beginning inventory, so we subtract those, and that tells us the total number of units that we need to produce. And this is how we calculate our production budget. Okay, now we're going to look at this example exercise together. If we are told we have projected sales of 45,000 units, then we would put this in as expected units to be sold. So let's go ahead and do that. And that is 45,000. Then we would put that, let's see, we expect to sell 45,000. We put that in. Then it says it's going to have to give us, we're going to have to be given our levels of inventory that we started with and the amount that we want to end with. It says the desired ending inventory is 5,000 units. So we're going to put that in as plus desired ending inventory. So that would be 5,000, and remember this is in units. So the total units required would be the sum of these two, which would be 50,000. So remember, the total units required is always going to be the amount we expect to sell plus however much we have, plus however much we want to have in our remaining inventory at the end. But we don't need to make what we came into this inventory with. That is your estimated beginning inventory. So we're going to subtract that out because we don't need to make that. It tells us estimated inventory is 3,000 units. And then that will tell us, when we subtract that out, that will tell us total units we need to produce. So the 50,000 minus the 30,000, which we'll just do it this way. So the total units we need to produce is 47,000. So that is how you're going to work the example exercise. And just to show you the answer, there it is. The total units to be produced is 47,000. And remember, we had to know how much we plan to sell before we can figure out how much we needed to produce.